Do you want to know how you can time the market and trade alongside the big bank institutions and the Forex market makers? Well, in today's video, we're going to get into part 2 of our timing series, and we're going to talk about how you can actually trade using the behaviors of the big banks and the Forex market makers to get big trades for a big profit. Stay tuned and watch the whole entire video, as you're not going to want to miss anything that I reveal in this video. Hit that subscribe button and hit the bell for notifications as well. You can do that while the intro plays. Here we're trying to build a community of retail traders who are trying to up their game to become pro retail traders. So let's get our mind into the trade, and I'll see you soon.
Deep in the Kent countryside, Richard Hill is still hard at work, checking the market with his bank's American branch.
No, but you've got to remember the whole world is long as sterling. Okay, you can hang on to early Far East, but I'll get rid of them sort of as soon as the Far East get going. I don't think you're going to make a fortune out of it.
Alright, pro retail traders and aspiring pro retail traders, I'm back with more information from inside the banks. As we just saw, we saw that basically Rich is talking to his counterparts across seas. And what you want to understand is that's how these market makers and banks operate. So they move money around based upon the positions of the day and their objectives. One thing you want to realize is Rich talks about the positioning of where everyone else is in the market at the time. So when he gets into the market, what's he going to do? You know, he thinks that he's going to beat up on, the pound at this time when he comes in, and they're talking about things that they're going to do beforehand. They're making tactics. They're not making tactics to trade the market in a manner of, let's try to scalp a few pips here, let's just try to ride out a swing trade. No, they're talking about how to make money by moving the market. And there's videos out there and people are saying that market makers don't exist, or they're basically just trying to match you up with some guy in New Zealand who wants to sell the pound and you want to buy New Zealand, and you both have 5 mini lots on the line, and to an extent that does happen, but not in aggregate, not how you think, not in world class top tier banks. Those players are in a different breed. They need liquidity, and they need to execute in a way and at points where it won't move the price against them and that they can make money. So what does this mean for us? What is this all about? So basically we're going to be talking about market timings. That's right, signals in the market at a specific time. Last time we spoke about how Brad Chesterfield and his boss, I can't remember his name, Ronnie Schlatford, were basically being ran around based on the spikes in the market. And I showed you how those spikes in the market happen at a particular time in the day. And normally it's late afternoon of any session, whether it's Tokyo, whether it's in London, whether it's New York. So one thing that I want to also point out is they also execute at the openings of the equities market hours for each session. We're primarily going to talk about the London, and we're primarily going to talk about the New York session. So execution does not always mean there's going to be a big move, because remember, the markets are a story, and the amalgam of information can only be discerned if you have an observant, objective eye. Remember that. You need to be observant, you need to be objective, and you need to train your eye, because there's phases of the market, and if you're not conscious of what phase the market is in on a micro level, on a macro level, you will be lost in the sauce. But I'm not going to let that happen to you. We're here together. Let's learn. So looking here, I want everyone to focus on just the maroon boxes. The maroon boxes on this chart are important. What they represent is the opening of the equities for trading. Now I'm going to get specific and tell you the hours. This right here is the London Open. Now the London Open, they just happen to have their banks open at the same time as equities markets. So for me, this is 3 a.m. Eastern Standard Time. It's only an hour. I only look at the first hour. So it's 3 a.m. to 4 a.m. This right here, this is in the New York session. And the New York session, actually, their equities open at 9:30. Eastern Standard Time. So this box represents 9:30 to 10:30 Eastern Standard Time. Notice I didn't say the banks. The New York banks actually open here. This blue box at the beginning of the blue box, because at 8 a.m. the banks actually open. But primarily, you do want to keep your eyes focused on the 9:30 a.m. Eastern Standard Time opening. That's where a lot of information can be gleaned. All right, so if you look here, you see that there's a big volatile move, big impulse, big move up. That's starting at 9:30. If you look here, you don't have that, but that doesn't mean there isn't something happening. As you can see, this is volatility contraction, and this volatility contraction all throughout the next couple of hours until this candle right here moves down, and then it basically comes into what we know is a stop run, a fake out, and price moves up. So if we look and we see throughout the days that price exhibits these type of behaviors, we can start to ascertain what the market makers are up to. So for example, if you look here, there was an aggressive move from the bottom of the Asian session, started during the London Open, continued a little past the London Open for a half hour, and then it faded. And then it never really broke that. And right here, during the New York Open of the equities markets, you actually see that this is actually a candle up that turns into a doji and then heads down all the way past the low of the Asian session. What does that mean? Well, this is a volatile compression day. So moving on. Now remember, everything doesn't have to happen on time. They're going to switch the timings of the move up. The move isn't going to happen every single time on cue. So for example, if you look here, this move actually starts slightly before the 9:30 move, and that's okay. The timings are like that. Around those times, you're going to see all of these clues. So the next day here, we've got volatility compression all throughout, and you're not really sure what's happening, but you know it's at the high. You're like the high of the Asian session. It comes down, but then we get this big shoot up. It could have been news, this is the February 13th. I'm not looking at what drove the market. We're just looking at what's happening price action wise. So we're looking here, and price comes back down, retraces this big move. This is our clue. Right here, right before the markets open, 9:30 futures markets, you have this spike up, turns into, you call that a shooting star if you will, and this is a doji next to it. And then price comes down. Price goes back up, then price comes down. This entire price action is extremely important. It's extremely important because it shows that there's weakness when new participants come into the market, when the equities market comes online. There's big money coming in. So knowing that this is happening during the futures markets open, this is a sign of weakness. This is an extreme sign of weakness. So you're probably looking like, okay, where's my next short? Because you've already had this right here. Up candle, great impulse, cleared the Asian high, but didn't hold. It's a great sign of weakness. This is confirmation. New market participants come in and can't get the market to go. All right. Coming over to the next day, you don't even get the close above that. And that is actually very, very, very important. And we'll get into how the market levels using certain market structure with the timings involved, because all market structure is not created equal. What time of day the market structure happens, how much volume was in the market structure when it was created, that stuff all matters. And we're going to get deep into that. But right now we're just looking at the market timings. So right here, big move, London Open, right here. New York equities markets open, big move, right here. This is not a big move, but look at all this valuable information. This candle opens and closes within the wick of this candle. This candle goes lower, runs the stops of the Asian session low, closes up inside of this candle. This is the opening. This is the opening of London. Remember, they're letting you know what they're trying to do. They're trying to pull a move. They're pulling a move. This is when they're going to pull their move. This is when the bank job is going to go down. Then we get this small candle that comes down here. And yeah, we don't know the volume. And we're going to start adding volume and things like that to the chart so that we can show you exactly how these things work out and play out and where the clues are. Because that's how you want to track these guys, based on the volume, not just the price action. But I'm just showing you pure price action. So once this actually comes down and you're like, nothing major. It doesn't really close anywhere below these wicks. Definitely not this wick. But then we shoot back up. That's your cue. Get into the market. If you want to wait for small retracement, you can. Now we're in US. What happens in the US? Well, we got all this volatility contraction in here, but look, we got this up candle, then we got this down wick, but it closes up. We get this down candle, then we get another up candle with a wick. It's almost the same exact pattern. And then what do we get? Boom, big move up. What are we seeing? We're seeing rejection and volatility contraction. Volatility contraction and rejection. Those are patterns. Those are patterns that tell you that the market is getting ready to make a move. Okay, so now we have right here, big move up, impulse, already in trend coming out of the Asian session. Then we get volatility contraction happens, but we finally break out when the New York Bank hours open and it breaks above it. That's another thing. Remember what I said, the market structure based on the timings of the day are very important. So as we see here, this high that was made during the London Open was broke here. And then it was held with this volatility contraction. So we're seeing no down movement. We're just seeing volatility contraction during the New York equities open. And then another impulse move out. Just like that. And if you just follow my words and you look for this stuff on your charts, you'll see for yourself. You'll look for volatility contraction. You look for volatility expansion or impulse moves. And what you'll notice is there are setups and clues during these times of day. You want to see what's happening when the big boys and girls come into the market and they start to show their hand. Market structure also at the time of day that certain things take place are very important, and we'll get more into detail in that. This is just to show you a concept and to improve upon the information we put out last time about the market timings and when they do certain things and what it looks like. And just continuing on, this is basically the same concepts. I'm just trying to find something that's a little different, slightly different. Okay, perfect. So right here, this day you see the volatility contraction, and then you see the break of that volatility contraction, right? And you get a big impulse move up. But where does it come back down to when it's time to test? This doji right here, this is not even a doji, it's like a hammer. And I really don't care for these candlestick pattern names. I use them so I can relate, so people know what I'm talking about. I don't even really name them. I just know what they look like and the volume associated with them. Honestly, I look at it in terms of market psychology, like what's happening. Like to me right here, I say this is big rejection and couldn't close here. So over this period of time, there's a lot of buying up, whether it's market orders or limit orders, and I actually use a software that allows me to see what's happening between market execution and limit execution, and we'll get into that in the future as well. But what I want you to know is the low right here lines up with the low of the London Open, this volatility contraction before it broke out. So this is a very, very important point. Also, if you look here, I told you about the timings. Everything's not going to happen exactly when the time the market opens and gives you that time between the first hour. 9:30, the market is already in downtrend. This looks like weakness, right? We come up, market can't continue. Come down, come up, has a hard time looking for buyers down here. It's looking for buyers. Comes up, we don't find anything inside here, and then boom. But what happens when the 9:30 session comes around? It continues on strong, but within that next half hour to the back half of that hour, volatility contraction, like nothing, like it's stuck. So it gave you a clue during the time. Then it moved up, but not really much, and then it came down. But it happened right after this. They don't move the market every single time at the same time, but the clues are around the same times every single time. So we get the rejection and then boom, big move up. You could make some money. That's pretty much it. If you go back through the video and you look at what I've explained and you watch the clips, you'll understand that you're looking for market timings and the price action associated with it. Just look through it. We're going to add more to it. We're going to get deeper into detail. Also, I want you to realize that those market makers that people say don't exist and they're not doing this, that, and third, I want you to watch this next clip and what Richard says, because it's all about the money, baby. You're not in this to be a charity. You know, it's literally a game of wits and psychology. Before I show that next clip, I want to show you a good resource. This is actually Euromoney.com, and I'll link to this in the comments. What you're going to see is this is an FX survey, all right, of 2018, and it's basically market share by institution type. So right here we have the banks and their liquidity provider, and this is the percent of market share. If you look at the top 5 banks, just the top 5 banks, JP Morgan, UBS, Deutsche Bank, Bank of America, Merrill Lynch, and Citi. If you add these numbers up, you will get over 50% market share. So just 5 banks, right? And there's more than 10 banks in the world, by the way, who are in the Forex market actively. But this is just the top 10, you know, who wants to put the top 20 up. Just the top 5 control over 50% of the market. So what are they doing? They're only making the spread off of each other. I mean, yeah, you're going to get different performance from different traders inside the bank on different days. But for the most part, is it really sustainable to make billions of dollars off of a micro spread? And remember, these traders are not using leverage like we're using leverage. So it's not like the banks have 1 to 200 leverage or even 1 to 10 leverage. They're not using that. They're using 1 to 1. You know, you might get some investment banks that, you know, use a 1 to 3, 1 to 5, you know, but that's someone trading a proprietary trading desk, and they're probably only handling $50 million. You know, we're not talking about the guy or the girl who's actually trading 250 million to 500 million for the bank, and they have some traders working around them at their trading desk. They're not using big leverage, huge leverage. They're not. Please, one move against them, you're right. So, you know, at the end of the day, they have to make money somehow. In another video that we posted, we talked about how Richard tells us it's commercial demand, baby. They're making the money off of other players in the game. They control the markets. They are the markets. If just 5 of them are 50% of the market, so they're only making money off of each other, it make no sense. The money would never go anywhere. It would always just stay in that circle. So look this up, understand what I'm saying to you, that they need to make money. They need to wait for orders to be piled up. They need to run stops. They need to get people offside. They need to absorb orders before they make a move, so they hold the market in place, because they are the market. So then the orders come one way and then they take it another way to provide for their needs. And they do that within a certain amount of room, leeway, if you will, because they can't do it forever. You know, we learned that. And they do it to make money. And you'll see in this next clip.
Richard Hill is already getting his first fix of the day with a call to his bank's Hong Kong office to see what's happening. And to give a special warning of what he intends to do to the pound, for their ears only.
Okay, mate. Well, I wouldn't be too long with sterling, because we'll probably try and bash it down when we get in. Try and look for a quick 50 or 60 points. I guess we do feel some pride in the pound occasionally, but it's not part of our job. I mean, primarily I'm there to make money, so if the pound's falling, I've got to take advantage of it.
There you have it. Hit that subscribe button and bell for notifications. Also, leave a comment down below telling me what it is you want to see more of. Sharing this will actually help other traders. So until next time, remember, to trade like a pro, you have to train like a pro.